Fed holding rates steady, marking the fourth consecutive time the Fed has not changed rates. Meantime, Fed Chair Powell saying a March rate cut, not likely, not the base case. So what does this mean for stocks and bonds? Let's bring in Evercore ISI's Krishna Guha, who heads their global policy and central bank strategy team. Krishna, actually, I want to ask you about bonds first, fixed income picture. We did see yields come down on this, which I guess is no surprise, but it seems pretty clear which direction overall rates are going to go in. So what does it mean for fixed income investment here?
Oh, yeah, for sure. I don't think there is anything here that changes the fundamental picture, which is that the Fed rightly assesses that the inflation data is moving consistently in the right direction. And before very long, it will be appropriate for them to begin cutting rates. The new news, as it were, is just Powell being very clear that March ain't happening, at least not unless there's some kind of break in the data, a labor market scare, let's say. So there were some folks who were over their skis on March. Obviously, that had to be taken out today. We've always been focused on May or June. And I'd say with today's good ECI wages, May is looking pretty good. And nothing Powell said threatens that story.
Okay, so how defensive should investors get, both when it comes to sectors within equities, and then when thinking about balancing their portfolios for 2024 and beyond between equities and fixed income?
So I think there is no scary new news out of the Fed today. Their take on the economy is fundamentally constructive. Growth is strong. The labor market is strong. And that's giving them the luxury of taking a little more time to accumulate some more evidence that inflation really is durably getting nailed down at 2%, not just touching 2% on some high-frequency annualized measures. Truth is, they think that is what's happening. It's just they look around and think things are great. Why rush? Why not get that extra information? So I do think that even though the equity market was pretty ugly today, I do think there's broad support here for a good news story in equities potentially spreading out beyond the big tech names. The economy's good. The Fed will be cutting rates.
Yeah, I mean, he was very clear, Powell was, in basically saying that what they're concerned about is not necessarily that inflation spikes back up again, but that it becomes entrenched at a pace that is higher than 2%, and that is perhaps part of the reason they're moving cautiously here. And I believe that was in response to a reporter asking about the fact that we've seen, including the latest PCE report, core PCE running at less than 2% on a 6-month annualized basis. So it raises the question on whether the Fed is actually getting behind the ball again in terms of that inflation picture. I wonder whether you think that's a real risk here, and if it is, what it would look like if it materialized.
So I would worry if the Fed looked like it was going to wait until, let's say, the second half of the year before cutting rates. I would worry if they weren't telling us that they do now see themselves as being back in the two-sided risk management business. But that's not what's happening, right? I think we should read this Fed statement, in particular Powell's comments today, as saying, not March, guys. That's a bit of a rush. We don't need to rush. But orienting us towards cuts starting in May or June. And as I said, I lean May. I think they'll end up delivering 5, maybe 6 cuts this year. So I just don't think that is deeply concerning in any way. You're right. 6-month annualized inflation is already clocking 2 on core PCE, actually a tick below. But of course, some of that is an assist from falling goods prices. They are not sure that's going to continue. If you X out that falling goods prices, 6-month annualized inflation is running more like 2.5. An underlying inflation measure that New York Fed uses puts it at 2.3. Those numbers will come down as and when housing-related OER cools off. They'll come down over time as wages cool off. It's all working. Just be a little patient.